on date, we've got 39 IND AS. All of them are notified by MCA, all of them gazetted, notified under Section 133 of Companies Act. All of them are available on the MCA website, free to download. So you please have, look at all the standards. So last time we had 35 standards, but now we have increased the number of standards. Why? Because from 2010 to 2015, IFRS itself has changed significantly. IFRS itself has changed, and that is the most important point I want to drive home, that accounting is now no longer going to be constant. It will always be changing. It will always be changing. And that is where we need to keep ourselves ready to deal with this change. It's no longer to say that if an accounting standard on mergers and amalgamation was issued way back in 1994, or a revenue recognition standard was issued God knows when, and those standards have not changed. We have not changed a comma, full stop in, let's say, AS9, for more than 20, 30 years. Whereas, the world of accounting has changed, the business has changed, the set of industries which has come, the way of life has changed, but we've not, felt the need to change the way of accounting. And I think that is what is going to change for us in times to come. Accounting will now always be changing. So as we speak, there are a number of projects which are out there on the table of IASB, which they are undertaking. A lot of them are almost at the final stage, and you will see new standards coming up. They do annual improvement programs of all existing IFRS, and they change IFRS every year. And when they will change it, we will be also required to look at all such recommendations, debate them, and then if we believe there is a merit in such change, and it will be very difficult for us to not to consider them, because we want to be equal to an internationally acceptable set of accounting and reporting framework, in that sense. So that is where now change is going to be the feature of our accounting and reporting platform, and hence we need to equip ourselves to deal with this change on an ongoing basis. So we've got several new standards, and the most important, what we're trying to do, because of our own transition, we are adopting standards which is yet to be adopted by the rest of the world, which is IFRS 9 and IFRS 15. So if you look at this, the sequencing of our own standard, so we have IFRS 1 to IFRS 15, and we're calling them as IND AS 101 to IND AS 115. So we've kept the same sequencing, and then we have IAS 1 to IAS 41. So what we are calling them as IND AS 1 to IND AS 41. So if there is no standard between IAS 2 and IAS 7, we have also decided not to issue. So we are keeping the sequencing. Paragraph references same. Our IND AS paragraph references and IFRS paragraph references, and the naming and all of that is fairly consistent and similar. If you have added something, we have inserted a new paragraph, say 39, then we have said 39A. We have inserted a new paragraph. If we have deleted a paragraph, we have not used that paragraph. Okay? So our referencing and IFRS referencing is almost same, and that is why we are also issuing 2 series. Just to give you a perspective, why this 2 series? So when I know International Accounting Standard Committee before 2000, okay, was in force, they used to issue IAS. Okay, after the Europe decided to converge to IFRS and the International Accounting Standard Board was formed, they decided to issue all new standard under IFRS series. Okay, all of them are IFRS, but they started naming them as IFRS, and before that it was called as International Accounting Standards. Now they are called as International Financial Reporting Standards, in that sense. So that's how the sequencing is. And then we also have something called IFRIC, okay, and we also have SICs. So IFRIC stands for International Financial Reporting Interpretation Committee, and SIC stands for Standing Interpretation Committee. So SIC used to operate when IAS was in place, and now IFRIC continue to be in place when IFRS are being issued. So IFRIC and SICs are nothing but interpretation of an existing accounting standard. So let's say we've got now, let's say e-commerce is the flavor of the day, where a lot of new innovation is happening in terms of the structuring of transaction, the way we want to do business, so on and so forth. Say IS 18 or the existing standard on revenue recognition is not equipped to provide an accounting guidance as to how you deal with revenue recognition in the e-commerce sector. Then what IFRIC may do, that they may add this to their agenda. They may look at IS 18 and they want to look at the business arrangement under e-commerce sector and try to link the two to give you an accounting perspective. That's the objective of IFRIC or SIC in that sense. So we're going to but what we have decided to do is that we are not going to issue any IFRIC, or we are not going to issue any SIC. We have added all of them, okay, as an appendix. We have added all of them as an appendix in respective IND AS itself. So we will not have separate IFRICs. These are added as appendix in the relevant IND AS, to which they belong. If there's an interpretation of a specific IND AS, we've just added as an appendix to that IND AS in totality. But we've adopted all IFRS, all IAS, all IFRICs which were in existence till 31st of August 2014. So all of them which were in existence till 31st August 2014 is being considered by us, debated by us, and now adopted by us. Anything new possibly we're going to adopt after now we do the mandatory transition. And in that process, what we have also done, we have adopted IFRS 9 and IFRS 15. IFRS 9 is a standard on financial instrument, and IFRS 15 is on revenue recognition. Now both these standards are globally mandatory from 2018. They are mandatory from 2018, but what we've decided is we are going to early adopt them. As of now, we are going to do early adoption of IFRS 9 and IFRS 15. It's one of the most complex standards, and we will talk about them during the course of this program. Now we also have carve-outs. This slide? Yes. May have been related to IAS. Yes. But they have been included in the IND AS, the series parallel to IFRS or IAS. No, they are either incorporated in IFRS or IAS. So similarly, we also have two series. If you look at them, included in AS 16, 17, 37. IFRIC should not have been, let's say, IFRIC 4 should have been related to corresponding IFRS series in India. No, not necessary. So IFRIC 4, for example, is on leasing, okay, and IND AS 17 is on leasing. Or IAS 17 is on leasing. IAS 17 is a leasing standard. So we have issued what? IND AS 17. And then you have IFRIC 4 is an interpretation of right to use. Okay, what is the meaning of right to use under leasing standard? Now that is added here as an appendix to IND AS 17. So IFRIC 4 is not necessarily relating to the IFRS series interpretation. That this may relate to IAS series standard also. Absolutely. So all the interpretation issued by IASB, which is International Accounting Standard Board, post 2002, when they were kind of being set up and incorporated, all the new interpretation they are issuing under IFRIC, because the existing committee has been dissolved. Yeah. Because the existing committee has been dissolved, which is SIC. SIC has been dissolved. So SIC no longer exists. So the only committee which they have now, which is empowered to do interpretation, is IFRIC, which is International Financial Reporting Interpretation Committee. So they do interpretation of both, whether it is IAS or whether it is IFRS, or maybe an interpretation of existing IFRIC also, possible, right? All of that they will be doing, yeah. Now we also have carve-outs. Now what is carve-outs? So, as we said, we wanted to transition to IFRS, we wanted to implement IFRS, but we wanted to have our own freedom to deal with the standards the way we deem appropriate. We don't want that somebody sitting in London is going to dictate us the way we are going to do accounting, but the fact of the matter is, yes, we are going to get guided by them, but we still wanted decision making in our own hands, right? And that is what has resulted into these carve-outs, that wherever we felt that we need deviation from IFRS standards. But if you have to give a perspective that in 2010 cycle, we were significantly off IFRS standards which were prevailing at that point in time. So, we were at that point in time close to 75 to 80% of convergence with IFRS. In the year 2016, when we are going to adopt IFRS or IND AS, we will be almost close to 95%, equal to international IFRS. And if you as a company going to make choices which are closer to IFRS, then you can possibly achieve 99% convergence with international IFRS as well. You may have 1 or 2 or 3 accounting entries which you may not be able to align to international IFRS, but otherwise we have significantly reduced the number of deviation from international IFRS. In fact, we are ahead of the rest of the world by adopting IFRS 15 and IFRS 9, well ahead of rest of the world. In fact, IFRS 15 is creating so much of debate. It's creating so much of debate because US is also transitioning to IFRS 15 in 2018. And you can imagine, the amount of planning, the amount of investment, the amount of, the landscape, the way they operate is very different than an Indian company. The amount of profits, Apple is making, or the amount of their business turnover every quarter, they make 10 to 15 billion dollars of profit. They are making, every quarter their turnover is 50 billion dollars, which is 10% of India GDP is one company. So the scale of change is gigantic again for US companies, which has resulted into significant amount of debate, which has resulted into delays in implementation of the new standard, which may possibly result into modification. So all of that is what we may need to deal with in advance, and that's a significant challenge to our mind for Indian companies to deal with if we were to implement, in the right spirit in that sense. So we have few carve-outs in the context of accounting for fixed assets, leasing, exchange differences, debt equity, bargain purchase, common control transaction, breach of provision of long-term loan, and then there are some other carve-outs in IND AS 1, 7, 23, 19, 20, 40. We will try and cover them, in respective standards wherever we're going to debate and discuss, during the course of the presentation in that sense. Now, IND AS is also, in a way, interact with other regulations, okay? And two most important regulations for us is Companies Act and income taxes. So we talked about income taxes, and when you look at Companies Act 2013, so we have amended Companies Act 2013. It's a whole set of new regulation which makes sure that everything which is required to implement IND AS is already been considered, whether it is consolidation of financial statement, depreciation of property, plant and equipment, all your related party transaction, the schedules, the notes, the format of your financial statement, your revision of financial statements, restatement of financial statement, what is it you need to do in the context of a fraud, significant error, etc. All of that has now been considered. Utilization of securities premium. Can a court in future approve a scheme of merger or amalgamation which is in deviation to the accounting standard? In future, courts may not be able to approve an accounting scheme which is in deviation to the accounting standard. Now, Companies Act nowhere provides an accounting guidance, which under Companies Act 1956, there were several places where accounting was prescribed under Companies Act 1956 itself. Now, all of that has been taken away from Companies Act 2013. In fact, Companies Act 2013 is very clear that if there is a conflict between the accounting standard and Companies Act, accounting standard will prevail. That's been written very clear under Companies Act 2013 itself. So that way, we've been able to address this. We've also been able to address this in the context of income taxes by way of modification of section 145 of the Income Tax Act 1961, and now we've notified 10 ICDS. Though IND AS is mandatory from 2016, ICDS is mandatory immediately from 1st April 2015 itself, irrespective of your size of the business or your net worth or turnover. It's applicable for every Indian company. Any questions?